Here we have Chris Chen, Senior Investment Director, Asia Pacific Sydney at American Century Investments. Chris, thanks for speaking at the Inside Network's Equities and Growth Assets Symposium.
Thanks for having me.
Okay, the tagline for the event is Sailing Through the Headwinds. In your opinion, how should advisors try to achieve this?
If we think about the headwinds in the markets today, where the headwinds over the last couple of years, a big part of that was the sort of higher, the rapid rate hikes. And I'd say that headwind's probably a lot lessened now, right? So the key thing about sailing through headwinds, and I like that analogy, right? It's not about lowering your sail, right? It's not about hiding in defensives, right? It's about being well diversified, trying to find different sails, right, that work at different angles, right? Try to have different engines that work for you. So being diversified, finding good alpha partners that, managers that can give you that additional alpha in addition to beta. And so that's how I would think about, sailing through macro headwinds.
I like the way you extended the analogy there. Well done. Can investors have confidence that the rate hikes are over, or should they remain vigilant and get ready to make further adjustments?
Yes, I'd say that rate hikes are likely over, right? If we look at what the Fed's saying, right? And we had the Fed come out last week with their with the latest dot plot projections, right? They're looking at 3 cuts this year, and I think the more exciting thing as we look at sort of that, how it looks a lot more dovish, right? As we think about the projection going forward, economic growth in terms of the expectation there within the dot plots are, they're expecting higher growth. They're expecting inflation to be slightly higher, and yet they're still going to go forward with their cuts. So I think that's something that should be very positive for risk assets like small caps.
So small caps, they often outperform the market when rates drop. Why is that?
Now, if you think about small caps and sort of the type of assets or the type of companies that you have in small caps. Now, first of all, there's the economic sensitivity angle, how they tend to be more cyclically sensitive. So when you have rate cuts, right, that's typically the start of a new cycle in the economy, right? Or that predates, so that sets up a new cycle. So from the economic sensitivity perspective, that should be sort of more positive for small cap stocks. Then you also have the balance sheet side, where small caps tend to be a bit more sensitive to higher borrowing costs. So when your borrowing cost comes down, small caps tend to sort of react more positively. And then lastly, it's just animal spirit, right? When you have rates coming down and small caps being on the riskier end or the more risk on end of risk on assets, they tend to do better as well. So I'd say a combination of sort of risk sentiment in terms of the economic sensitivity and also on the balance sheet side.
And those animal spirits.
Animal spirits.
Very good. And so what areas or sectors or themes within small caps are you finding most attractive right now?
I think with small caps, right, I can go into the themes, but then, the one thing to remember, it's like it's such a broad universe. We're talking about 7,000 plus companies in the MSCI All Country World Small Cap Index, right? So you can be very picky, very stock specific, right? But then in terms of individual themes or sectors, AI is certainly one. But then the difference here is we can find companies that are sort of in the second derivative of AI that go into that supply chain who can win regardless of sort of who wins on the headline, right? Or there's a nearshoring theme that's also very exciting within the small cap space, where companies are bringing back supply chain to developed markets, to North America, and that disproportionately benefits small cap companies. So there are various different themes that I think are very exciting within small caps, but then really comes down to stock selection because again, 7,000 stocks over, right? So there's a lot of opportunities for active managers, with a well-resourced team and a good disciplined process to add value there.
Very good. And where do you think some market surprises might come from this year?
Well, if I can name the surprises, then they won't be surprises anymore. But, if we look at market surprises or the key risk factors, right? Interest rate and inflation, that's been the key risk to market. And I would argue that risk is vastly lessened today, right? The visibility to Fed rate hike is much greater today than even just a few months ago, right? And what we're seeing on the inflation side, again, the visibility is much better today. So a big part of that macro risk has been sort of vastly diminished. So I'd say that the remaining big sort of binary type of uncertainty would be on the geopolitical front, right? So I think that will continue to dominate markets. We're also in a year where a big part of the world's population go into elections, and with the more important one towards the end of the year, right? So that's something that could have an impact, on financial markets. But which is why, going back to your first question, right, about how to sail through these challenges and just be really well diversified and not take very huge binary bets. And so I think that would be a good way to help sort of navigate through some of these challenges.
Keep those sales up. Very good. Chris Chen, thanks for joining us.
Thank you very much.